Hi, I'm Brock.
I'm Jim.
Before we get started, if you want to stay ahead of the cattle markets, sign up for our free daily briefing at herdadvisor.com. It's delivered right to your inbox every morning, 5-minute read. And if you've ever wished you could keep complete cattle records without the clipboard, the Cattle Record Guide lets you enter records from the field with your gloves on. Just say, "Hey Siri, try it free for 14 days at herdadvisor.com.
All right, welcome back to Cattle Market Guys. It's July 17th, and we've got a lot of ground to cover this week. Let's start with a snapshot. According to the data, 500 to 549 weight steers are sitting at $451.20 per hundredweight for the week of July 5th, and that's actually down from $456.53 the week before, and down again from $455.93 the week prior to that. So we've got a clear 3-week slide in that weight class.
That's a pretty consistent bleed for 3 weeks running.
It is, and the 600 to 649 weight class is telling a different story, though. Those steers came in at $414.47, down slightly from $421.80 the week before. But if you look back a month to the week of June 7th, they were sitting at $411.80. So that weight class has actually gained ground over the last month, even with this recent softness. Futures are the real story here, though. Front month futures dropped from $368.94 back on June 21st to $360.89 this week. So the board's lost about $8 in less than a month.
$8 might not sound like much till you're the one holding 600 head waiting on a contract date.
Exactly, and the articles back this up. The cattle site reported beef prices hit their lowest since February on Monday the 15th, and then by Wednesday, that's yesterday, cattle futures hit their lowest close since March. Chart-driven selling, weak cash trade, sagging wholesale beef prices, it's all pointing the same direction. Now looking at the predictions, the 600 to 649 class is forecast to keep sliding, dropping to $390.24 by the 2-week mark before bouncing back some. The 500 to 549 class actually shows some recovery in the 2-week window, climbing to $450.77 before easing off again by week 4.
So it's a mixed bag depending on what you're running.
That's a fair way to put it. Volume's been steady too, nothing alarming there, mostly average across the board, so this isn't a liquidity issue, it's a genuine price correction. Jim, you've seen these kind of slides before. What usually shakes out?
Well, it usually shakes out that somebody who wasn't paying attention gets caught flat-footed. That's about as useful as a screen door on a submarine, watching the board and not knowing your own numbers.
Which is a perfect setup for our first deep dive because this pullback in cattle futures deserves a closer look. Let's talk about what's actually driving it. So diving into this futures decline, we had 3 straight sessions of downward pressure documented this week. Monday the 15th, futures closed mostly unchanged after a choppy session, but that was already following weaker cash cattle trade from the prior week. Then Tuesday the 16th, we get a clean decline. Chart-driven selling on top of sagging wholesale beef prices. And by Wednesday, yesterday, futures hit their lowest close since March, with the article specifically citing weak cash cattle prices, technical selling, and declining wholesale beef prices all compounding together.
That's 3 days of bad news stacking up on itself.
It really is a compounding effect, and here's what's interesting. Hog futures actually moved the opposite direction. Pork cutout topped $101, and hog futures climbed even as cattle fell. So this isn't a broad protein demand collapse. This looks specific to cattle and beef. There's also an article floating around this week called Recency Bias and Things That Never Happen out of Beef Magazine, and it's worth mentioning because it touches on something relevant here. It references Arkalf's Eric Gropper talking about cowherd expansion and how past market columns predicted expansion trends even amid volatility like we're seeing now. Basically, the point is producers shouldn't overreact to a few down weeks and assume the whole cycle's turning.
That reminds me of something similar, and I mean this one's a real one, not just a similar situation. Back in '93, we had almost this exact setup. Cattle had been trading strong all spring. Everybody was feeling pretty good about themselves, and then that summer, the bottom just started falling out of the board. Beef demand went soft, packers backed off buying, and cash followed the futures right on down. I had a neighbor who'd contracted some feed based on where the board was sitting back in June, and by the time August rolled around, he was looking at a real different number than what he'd planned for.
What happened with him?
futures eventually stabilized by fall once demand picked back up like it usually does seasonally, but a lot of guys who didn't hedge or contract early just ate that difference in the meantime. It wasn't pretty for a few months there.
That's a valuable comparison because the lesson tracks with what we're seeing in the data right now. This 3-week slide isn't necessarily a signal to panic, but it's also not something to ignore. Watch the cash market specifically, because if cash starts stabilizing even while futures are soft, that tells you the fundamentals underneath are steadier than the chart action suggests.
When the board starts sliding on chart selling and weak cash, don't panic and don't chase it down, but don't ignore it either. Know your break-evens before you need them, not after.
That's the kind of practical takeaway producers need heading into next week. Let's shift gears to something that doesn't get talked about enough on this show, and that's the regulatory and land use pressure ranchers are dealing with right now. 3 stories this week really stood out. First, out of New Zealand, a study linked farm nitrate pollution to about 120 premature births per year, and the concerning part is researchers found risk even below the legal nitrate limits currently in place. That's Reuters reporting through the cattle site, and it's the kind of study that tends to ripple into policy conversations well beyond New Zealand's borders.
When they start finding problems below the legal limit, that usually means the legal limit's about to move.
That's exactly the concern, because regulatory bodies often respond to those below threshold findings by tightening standards preemptively. On a more positive note, the FAO joined Canadian ranchers this week for the International Year of Rangelands, and their Director General actually took part in an Alberta ranch tour, highlighting how grasslands contribute to food security. This is a case where the international regulatory conversation is actually working in ranchers' favor, positioning grazing land as an environmental asset rather than a liability.
Good to see somebody from the UN out walking pasture instead of just writing memos about it.
Fair point. But then we got the third story, which is a lot more sobering.
That's all for today. Remember to sign up for our free daily briefing at herdadvisor.com. And if you want complete cattle records without the hassle, try the Cattle Record Guide free for 14 days. Enter records from the field with your gloves on. Just say, "Hey Siri."
Catch you in a couple days.
All right, see you then.